Have you ever wished you could combine the power of data driven models with the real world insights of fundamental analysis? What if I told you there is a strategy that combines both? Well, in this video, we are diving deep into quantamental strategies, okay? The game changing approach to trading that blends quantitative analysis with fundamental analysis to give you a serious edge in the market. Now, before we get started, make sure to hit that like button and subscribe for more insights into smarter trading techniques. Okay, let us dive in. So, let us begin by answering the most important question: what exactly are quantamental strategies? Simply put, quantamental strategies are a hybrid approach to trading that brings together the best of quantitative analysis and fundamental analysis. All right. Now, quantitative analysis is all about numbers, data, and statistical models, right? Traders using this method rely heavily on price data, trading volumes, and other technical indicators to inform their decisions, right? It's often automated, involving complex algorithms to spot patterns and forecast market behavior, right? Now, fundamental analysis, on the other hand, focuses on the underlying factors driving the market. This could include things like company earnings, industry trends, macroeconomic conditions, and even geopolitical events. Now, it is more about understanding the big picture and less about crunching the numbers. Now, quantamental strategies combine these two approaches into a single strategy that allows traders to analyze the market from both a macro and micro perspective. The macro perspective is the big picture, while the micro perspective is the data driven picture. All right. Now, think of it as having the best of both worlds: the data driven insights backed by real world economic factors. So, how does it work? Let us break down how quantamental strategies actually work. The first step in this strategy is using quantitative models. Traders typically look at large data sets, price movements, trading volume, historical trends, you know, and all of that to predict where the market might go next. These models give you a solid understanding of potential price movements and trends based purely on data. But here is where it gets interesting. You don't rely on quantitative analysis alone. You also bring in fundamental analysis. So once the quantitative model identifies a promising trade, you then take a look at the economic landscape. For example, are there any upcoming earnings? Earnings reports. Are there any upcoming earnings reports that could influence the market? What is the broader economic trend? Is inflation rising or falling? Is there any geopolitical news that could have an impact? By combining these two perspectives, you get a holistic view of the market. You are not just trading based on raw data, but also based on the context behind the data. So this makes your trading decisions more informed and grounded in reality, rather than just relying on pure technical indicators. For example, imagine you find a trade setup on your quantitative model. It's showing strong data suggesting that the price is likely to rise. However, when you check the fundamentals, you realize that there is a major economic report coming out that could drastically impact prices. With this information, you might decide to adjust your strategy, maybe even avoid the trade or wait for the report to pass. So, why do quantamental strategies work so effectively? Well, it is all about the combination of data driven analysis and the human touch provided by fundamental insights. So, here are a few reasons why this strategy is so powerful. The first reason is data analysis with context. With data, while data driven models give you predictive insights, they don't tell the whole story. By incorporating fundamental analysis, you add context to the data, allowing you to better understand the why behind the numbers. And then reduced emotional bias is also another reason why this strategy is powerful. Often, traders let emotions drive their decisions, chasing after short-term price movements or overreacting to market news. With quantamental strategies, you are relying on objective data and real-world fundamentals, which helps reduce emotional bias and keeps you disciplined. Another reason is increased reliability. By using two complementary approaches, you are increasing the reliability of your trading signals. A trade that shows both strong probability trade, a trade that shows both strong quantitative data and supporting fundamentals is more likely to be a high probability trade. It's all about reducing risk and stacking the odds in your favor. All right, and then finally, we have smarter risk management. Combining both approaches also helps in risk management. If your quantitative models give a positive signal, but your fundamentals suggest caution, you might decide to reduce your position size or wait for more confirmation. This helps protect your capital and minimize risk. So, how can you get started with quantamental strategies? It might sound complicated, but it's actually simpler than you think. Here are a few steps you can take to integrate this approach into your trading. The first is understand both analysis. Start by learning quantitative analysis and fundamental analysis. You can begin with basic resources on technical indicators, chart patterns, price action for quantitative analysis. All right. Then for fundamental analysis, you can read up on economic indicators, financial statements, and other factors that affect market movements. Secondly, develop or use models. If you want to use quantitative models, right? If you want to use quantitative models, start with some basic trading algorithms or use ready-made tools. Many platforms provide indicators and data points you can use to track trends and predict price movements. Next up, look at the big picture. Never just rely on numbers. Always complement your analysis with a check of the fundamentals. Know what economic data is coming out, what's happening in the geopolitical landscape, and how these things might impact the market. Also, you have to backtest your strategies. Once you have a strategy, backtest it. Use historical data to see how your model would have performed under different market conditions. This is essential to ensure the strategy is solid before risking real capital. And finally, stay disciplined. The key to success with quantamental strategies is discipline. Stick to your plan and avoid emotional decisions. When both your quantitative models and fundamental analysis align, you will have a high confidence trade. And that is a wrap on quantamental strategies. By combining the power of quantitative analysis with the insight of fundamental analysis, you are able to make smarter, more informed trading decisions. If you found this video useful, make sure to hit that like button and don't forget to subscribe for more content like this. Drop a comment below. Have you tried quantamental strategies before, or are you planning to give them a shot? Let us discuss. Until next time, trade smart and stay ahead of the market.